Good afternoon, ladies and gentlemen, and welcome to the CQS New City High Yield Fund Limited investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and will publish those responses where it's appropriate to do so on the Investor Meet Company platform. Before we begin, we would just like to submit the following poll, and if you could give that your kind attention, I'm sure the company would be most grateful. And I would now like to hand you over to Chair Caroline Hitch. Caroline, good afternoon.
Well, thank you very much, and a welcome also from me to this CQS New City High Yield webinar. As Jake says, my name is Caroline Hitch, and I have the privilege of being the chair of the independent board of directors of the company. Most of this session will be Ian Franco, our investment manager, giving an update on the investments in the company's portfolio. But I'm going to start off with a few big picture comments. A few weeks back, we released our interim results for the 6 months to December 2024. For this period, the net asset value total return was 3.6%, and the share price total return a fraction lower at 2.9%. You may remember that over this time, sterling bond markets, such as the gilts market, were actually quite weak, but we nevertheless generated a positive return, which I think is a good result and highlights the diversification value, amongst other benefits, of holding high yield bonds. I also suggest that CQS New City High Yield is a good way of accessing this asset class, which is not totally straightforward to do. And I've held shares for many years in the company, even way before I joined the board. So turning to the second half of our financial year, starting in 2025, the portfolio had a strong January, but has given back some gains more recently, as even high yield bonds are not completely immune from the market turbulence triggered by Trump's tariff announcements. There'll be more of this later in the webinar, but I think we can be reassured by the team of credit analysts at CQS who monitor the bonds held in our portfolio for their credit quality. Finally, we've paid 2 dividends of 1 pence per share each so far this financial year, and are on track to pay a covered total dividend of at least 4.5 pence for the full year. The yield on the shares was 9% as at last Friday's close, which we know is very appealing to shareholders, which includes myself. The shares of the company continue to trade at a premium to their net asset value, and there are very few London-listed investment trusts that can say that. We just ran the numbers as we were waiting to start this webinar, and the premium is currently a little bit over 7%. We're issuing shares in small amounts fairly regularly, and you may have heard me say this before, but I think it's worth reiterating that we only issue when our investment manager is confident he can invest new monies beneficially. He has the final say. So thank you for joining this webinar. I'll now hand over to Franco to talk about the investments.
Thank you very much indeed, Caroline, and thank you everybody for joining us in interesting times as regards markets. Obviously, many of you will know what CQS and the High Yield Fund is, but just popping through quickly through the slides. We are part of Manulife CQS asset management, and have very good specialist credit research and also very good experienced fund managers across the board here, which is exceedingly useful. The current assets of the fund, just over 318 million pounds. So this was done, I think, this last week. So the yield is currently just near 9% than that. But I have been managing this fund since August 2007, and we have been through some very interesting times, GFCs, COVID, and now Trump tantrums, tariff, whatever you wish to call it. and I will comment on those probably before I start about the portfolio. These are historic. Last year was an incredibly good total return. As Caroline has already mentioned, obviously they are lower in the 6 months up to the end of December, but when you've done 19%, you're not going to do that compound. It is not possible. You just maximize where you can and make sure that you don't give it back in more difficult times. Dividends, I mean, Caroline has covered that as well. We do like to keep growing the income by small amounts, which is pretty much unheard of in bond funds. It is very important that all of us shareholders get those safe dividends going throughout the year and years. I am also quite a substantial shareholder now. I'm just under 700,000 shares, mostly in my ISA, and those I add to each month and reinvest my dividends. So for me, it is a great compound interest is a great source of increasing your capital when it's put in a tax efficient wrapper. This is just a sort of performance, and since I took it over, I think probably the interesting one really about this is the all share index, which it is this sort of benchmark that many equity fund managers fail to beat, and it just shows that bonds used correctly, you can leave equities behind as well in difficult times. The investment process, this has been pretty much in place since October 2007, when CQS took over the new city element of the management. We use our analysts for screening new issues, current issues, relative performance of different sectors, and there's a lot of work goes into my decision making, which at the end of it, yes, I have the final say, but I have taken into account research from some very, very good analysts here at CQS. We also use research from boutique broking houses, because we find that the boutiques, which do not have a vast amount of corporate issuance, tend to give a less biased view on the credit of companies. So we put that all together, and you try to keep the portfolio as diverse as possible. Obviously, there are some sectors that do not have high enough yields for us to invest in, but it is my job to make sure that we are as diverse as possible. So when you have market ruptions such as we've had recently, things do not look too painful. But above all, we're an income fund, so it is the safety of coupons paid in the bonds and the dividends paid in the equity element that is very, very important. Right. The sector positioning, this was as at showing as at June last year, has not changed an awful lot since then, but this sort of gives you an eye into how we spread the portfolio. Obviously, financials are the largest element, because that is where we can get the most income, and with the benefit of having an exceedingly good financial analyst, we can get into some very interesting opportunities there. And I'll give an example. Earlier this year, we had the opportunity to invest in a Newcastle Building Society, which was only a 40 million issue when it came. And because it is that small, the majority of investment managers do not even look at it. We were able to take a holding in that, and thank you very much, it is paying us 14% and is performing, very, very stably in current markets, which gives you an idea of how it operates. So that's the advantage of it. I mean, this just is investment themes and pursue. We have a very good risk department here who monitor limits. They make sure that we're not borrowing too much. We are well within inside our covenants. But the risk people probably just see them just behind me, so that we're not far from them. So if anything ever looks odd, we have a heads up from them. Fortunately, as I say, even in the last sort of few weeks, it has been pretty quiet from that side. And here we give you the top 10 holdings, which again shows the amount we are in financials. Shawbrook is a competitor bank. It really is well managed. Virgin Money, which is now part of Nationwide, again, very good coupon, but the advantage of getting involved in something when Christian gave me the heads up on this one some time ago was we were buying something below par with a double-digit yield. Then along comes Nationwide, and we end up with a slightly lesser yield, but the bonds are trading above par. So you get your capital gain from stock selection and making sure that you're rightly sized. Because the risk reward is everything in this. Other large holdings, Travelodge, which again, it has been sort of benefiting the last 4 years really from post-COVID recovery. Below that, we've got Galaxy Finco, which is domestic in general, which looks after various white goods warranties and service agreements for the large retailers. Again, doing exceedingly well. RL Finance, which is Royal London, very, very well managed. Mutual, again, that came out with a very, very high coupon when it came, and is currently actually trading at about 109. So we've got again capital gain from these. REA is a spot producing palm oil business in East Kalimantan, and it is basically it doesn't export. It provides product to local businesses and local domestic demand, and it is exceedingly well managed. Has been a long-term hold. Co-op Bank, again, another company which very, very well managed bank, very, very green. It has been one that when it refinanced, it wasn't too long after the Liz Truss market volatility, so they had to pay up for the coupon. And these two have been taken over by Coventry Building Society, better quality, and that has been trading up at about the 118, 119 level. obviously, with a end date of about 2034, it is one that was larger, and we have been selling down just really because I do not wish to transfer capital into the income account. As and when we get other opportunities, to get similar running yields at par or preferably below, that will be a source of funds. Barclays is, again, obviously top quality UK bank, trading just around par, so that does its job. Aggregated micro power provides wood chip and boilers for lots of local authorities and various other power demands. Again, it's been a very excellent performer because it is very consistently trading around par, which is what we want. I mean, even in markets as they are now, it is not moving. And I'll finally finish off with Stonegate, pub company, very well managed, has been selling off parts of estate that it doesn't see producing enough revenue or best returns in the future. That refinanced about just over a year ago, and we are sitting there with a bond that again is comfortably in our yield target, and with an excellent analyst covering it here, it is something I'm sort of updated with, certainly monthly, or if anything, any news comes out, more often. But that's the top 10, and the top 10 is about 34% of the portfolio. So it gives you a sort of feel as to how we sort of manage it. The stocks you really love, you've got a larger weighting, and as the risk, if the risk is greater, then it will be a much smaller allocation and much further down the portfolio. And just because it's a smaller position doesn't mean you're looking at any less. In fact, probably you spend more time looking at the smaller ones to make sure they're okay, because it's, if you take your eye off the ball, they're the ones that can bite you. Right. Share price dividends. Well, I think that sort of speaks for itself. We have definitely here, focused on what is most important, and which is, providing, a stable and preferably growing income for our investors, whilst not taking too much risk to have the capital hit. Obviously, you see the big dip there in 2020 when COVID hit us, where you see how little the NAV moved in relation to how far the share price went down. And this is something which was also gave opportunity for one or two investors to get involved, whereas in markets like this you have a problem because market makers do not stand by their prices, that they don't want to end up with a lot of inventory that they can't shift. So they will just keep marking down until a sensible buyer is found, and then hopefully they'll put together panicking sellers with the more savvy buyers. But as you see, this only lasts for a short period of time. Well, I think we've covered this one, the themes, and that's really the presentation. Now, I think everybody will want to know what my and my colleagues' views on Trump's tariff and the effects on markets. obviously, hands up. Like anybody who has a logical brain, I do not like tariffs. The reasons I'll give as follows. One, tariffs give you uncertainty in markets, and it's not just in equities, fixed interest, it's government bonds, and it's also the currencies. So, as we all know, markets, like to be in a stable situation, and this is probably the least stable I have seen this in my nearly 49 years in markets. Inflation is also a big danger with tariffs because costs will be passed on to the consumer, and also as part of this, you will hit your currency. I mean, the dollar has been pretty weak over the last few weeks. It is down 10% against the euro, and it is only down 5% against the UK. But effectively, if you add this to the tariffs, your actual inflationary figure in the States, could be quite horrendous. Obviously, another big danger is unemployment, not just in the countries that are getting the tariffs, but also in America as well, because it is not a switch where you can say, right, we're now producing all of our goods that require here. It isn't going to happen, and with retaliatory tariffs as well, now your industries are going to get hit. Part of that is also productivity. The reason I mention productivity, really, it encourages inefficient production due to protection you have done against cheap Chinese imports or cheap European imports or cheap UK imports. So it isn't going to make America great again anytime soon. Obviously, as part of this, if productivity is down, then your export capabilities will also be weakened. And more of a political one, it promotes nationalism, which in having been brought up post-war in a sort of more global times, I think this is potentially dangerous for other things. But if there are any questions, please fire away, because it's a very interesting time to be making a presentation like this, because markets are still recovering as we speak. Some equities are up 2.5% today, others haven't changed. So these are big moves that we are seeing in relation to markets that really are a lot more, or have been a lot more stable over about the last 18 months.
Franco, if I may just jump back in there, thank you very much indeed for your presentation this afternoon. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab that's situated on the right-hand corner of your screen. But just while the team take a few moments to review those questions that have been submitted already, I'd just like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can all be accessed via your investor dashboards. Guys, you can see there we have received a number of questions throughout your presentation this afternoon, and thank you to all of those on the call for taking the time to submit their questions. But Craig, at this point, sir, if I may hand over to you to chair the Q&A, and if I pick up from you at the end, that'd be great. Thank you.
Well, thank you, and good afternoon, everybody. My name is Craig Cleland. I support Franco and the team at CQS. So Caroline and Franco, let's have a look. What have we got? Franco, you've covered tariffs, questions about tariffs, so thank you for that. Specifically, anything in the portfolio, especially in the US? The FT are reporting that some of the US high yield market is really struggling. Do we have any exposure there and anything you're worried about?
No, there's not too much that I'm particularly worried about at the moment. Or you could say that until we get a little more clarity, because obviously we're in a 90-day sort of it's almost a calling off period at the moment, while President Trump decides what his next game plan is going to be. But by and large, the biggest hits have probably been to the oil sector. Looking elsewhere in markets, a lot of things have recovered, but no, it's nothing particularly worrying me. I mean, obviously, when you have this sort of move in the market, liquidity in individual stocks and that disappears, spreads widen, so your NAVs will, definitely, be hit. Because obviously you're valued off of the bids in the market, not the offers. I mean, if you're on the offers, you'd probably go up because, as I say, the spreads have widened. But no, that's fine for me on that one.
Thank you, Franco. Obviously, these market dislocations sometimes throw up some interesting opportunities. Have you been you've been issuing shares with the company, which is great. What are you doing with the money? What you're buying? What you're selling? Can you say anything? I know we haven't published our latest fact sheet until at the moment, so if you're worried about building a position, please be careful. But is there anything you can say to our audience today? What you've been buying and selling?
Yes, I can sort of say. I did mention that one of the things I have been doing has been using Co-op Bank as a possibility for liquidity. I have sold some of those this month. Where it's on the purchases so far, I mean, I'm looking in the sort of the food sector is one area that I think has opportunities, because they get marked down as well, and we're not going to stop buying food or whatever else. So where I've seen bonds there marked down by 3 or 4 points, I have tried to buy a bit of stock, and by and large, yes, we've picked up some. I would have liked to pick up more, but guess what? They're back to the levels where they were prior to Mr. Trump sort of playing around with the market.
Okay, thank you. A question about gearing. I can probably answer this one. How does the fund use gearing? What is it currently? Well, the fund has a facility from Banque Nationale de Paris, Paribas. It's £45 million sterling. We're currently using £35 million of that drawn. So we always try and keep a bit of ammunition and firepower for the fund manager. So today we're 12.2% geared. Gearing's normally in a range of around about 10 to 15%. So Franco, you're very happy with that? Would you be looking to spend any more if things come up?
Yeah, I'm very, very happy where the current level of borrowing is at. Yes, if markets look like they are going to be more logical and a little less volatile, then I would like to increase the gearing, because there are opportunities out there, but obviously, again, my natural cautious nature is that gearing works both positively and negatively. If we have another sort of Trump tantrum and markets go down 5-10% like they did recently, then it can hit your NAV, which is not what we're there for. But maybe if we do get one of those situations again, then it could well be an opportunity to put some money in using the gearing.
Okay, thank you. We should also explain to listeners and shareholders that quite a decent proportion of the fund is in floating rate notes, Franco. So investments in bonds are subject to kind of where the interest rates are. What happens if the interest rates go down, say 1%, 1.5%? Does your income correspondingly fall? How does that work?
Yes, but most of the floating rate notes that we're in, the floating rate element only kicks in when the bonds become callable. And I think in the past, a lot of these have been called at the first opportunity. So effectively, the company either refinances it or repays it, and we move on to something else. But we're not seeing any of these bonds being hit by potential lower rates. Obviously, interest rates are going to be very interesting over the next few months, again depending on what President Trump does. Currently, when you expect to see a little more inflation, and we're not going to see an awful lot of growth. Stagflation is a big danger, and conventional wisdom would say that they would cut rates to sort of try and get the economy moving. But I think the inflation is something that certainly the central banks do not want to see rearing its ugly head again after what we've just been through.
Okay. Now here's one for you, Franco, with your longevity. Great total return for the company, but we've seen the capital NAV fall a bit. 7 or 8 years ago, it was around about 56, 57p. It's currently 50p. What's happened? What hit you a few years ago?
Well, COVID was a big hit for the pretty much everybody. That's when the NAV fell the most. As you go back to see if I can find the slide.
Yeah, I think I remember things like Matalan affected you, Franco. That was
Matalan, the retailer, which was I'd say that was trading just under par pre-COVID, and along comes COVID, and basically it was sort of in a situation where it was in default within 3 months. So situations like that will hit your NAV. Obviously, also we've had Raven Property Group, which partially is Russian large warehouses around St. Petersburg. That is currently in an Abu Dhabi vehicle. We have it at zero value, but there is a possibility that that will come back with some. But yeah, I mean, we've had situations where NAV has been hit. I'm not happy about it any more than anybody else is, but the total return is what it is all about. And at the end of the day, it would be nice to get it back up to 60p. It is possible that we can get back up there with in time. Lower interest rates would do that, because obviously lower interest rates would make our bonds that much more attractive, and push them above par. Okay. But that's unfortunately what markets do to you.
Well, thank you. And in talking about markets, your views on REITs and renewables. You used to be, you had more of those in the past, not so much these days. Any thoughts? Yeah.
I have my biggest position in renewables is Next Energy Solar, and yes, I have small positions in a few REITs. I mean, interestingly, we've had a recent flotation of Achilles Investment Trust, which is aiming to shake up the REIT and renewable space to get them trading to closer discounts to par than they currently are. I mean, the first one that they have attacked or appeared on the shareholder register of is Urban Logistics, not one we hold, but the share price has, if I remember rightly, it is up something like, from when they started, it's up about 30%. So, what they have done there is, shaken the management into action, and we wait and see, how they manage to improve the value and get returns better for shareholders.
Okay, thank you. Just to confirm again to the listeners, today I know you watch the portfolio very closely. Nothing's kind of causing you to lose sleep. Kind of nothing's going to kind of fall out of bed.
No, I mean,
you don't know of anyway.
The thing, as I say, quite a few of the spreads have widened. They are starting to tighten back in again. At the moment, there is nothing that is sounding very large alarm bells. I mean, historically, the ones that have hit us have been ones where politicians have got involved. Obviously, Raven Property was an obvious one. And we had a very small position in Credit Suisse, where the Swiss government decided that it was going to change the rules. So there's nothing liquidity-wise or that is worrying us, but beware the politician.
I think anyone reading your fact sheets, Franco, would know that's your views on politicians.
I've met far too many of them in my past.
Here, I'll let you rest for a second. We've been asked a question about how big our revenue reserves are in the company. Well, good news for an investment trust here. We hold a full year of dividends in our reserves. So in other words, if we got nothing for a year, we could keep on paying out dividends for the whole year. That's very unlikely. What it does give you is the ability to smooth things. If something, for some reason, there's a market dislocation and someone doesn't pay us, hopefully the board will look at that yield and say, we can continue to pay, we can continue to keep the dividends stable. So having a revenue reserve and the fund manager and the board have been very careful trying to build it back up over years when we've overearned, not to pay too much away. So shareholders may say, well, why are we only getting a tiny little dividend increase? The reason for that is just being prudent, just being careful, just making sure we've got those reserves to, for a rainy day in the future. So it's a good position to be in. Franco, the market itself, new issues in the States, they're a bit frozen. Have you seen anything, new issues coming along?
Yes, I think by and large, what happened, on the 2nd of April has shut down the sort of the high yield markets, and sensibly, companies wishing to issue are waiting for a little less volatility, because the last thing you want to do is announce an issue and then later in the day you get a sort of a tweet coming out of the White House and your sector gets hit. So I think once markets calm down, and bear in mind a 90-day sort of wait until we hear what is going forward from there. It takes us very close to the sort of summer holidays. So there might be one or two brave or scared companies come say we've got to get some finance.
I think we should explain. I think we should maybe explain to investors and those listening is that this is very much not a trading portfolio. It's very much buy and hold and wait till they repay, Franco. So you're not really
That's right.
worried about day-to-day trading, are you?
No, I mean day-to-day trading. You know, as I say, we're valued off the bids. So, you know, if you buy and sell an awful lot, you're throwing away arguably 1% every time you deal. You know, possibly more. So, you know, the lower we can keep the turnover, the better. You know, this is one of the reasons that you know, we will not issue you know, stock below a 5 premium, purely because by the time you've taken out market spread, fees, and, you know, potential market movement, you know, you're not enhancing existing shareholders' capital, which,
yeah,
to me and everybody else that holds it, is, you know, sacrosanct.
I'm going to combine two questions here. One person has asked about your holding of Newcastle Building Society at a 14% yield. How can that be? And another question is, are you seeing opportunities to increase or generate your target income? So I think that one kind of explains both. Do you want to explain how you ended up with a holding of a building society paying you 14%?
Well, you know, it's obviously a tier 1 piece of paper, and, you know, regulations require that they have a certain amount of tier 1. And the problem is for them, if you're issuing a very small amount of paper, there's only probably 10 or 11 fund managers in London that can get involved in this.
I think maybe explain what small means, Franco. 50 million is tiny, isn't it, in this market?
Oh, yeah. I mean, if I was working at one of the the major houses, and you were part of a you know, a high yield bond fund that was, say, you know, £2 or £3 billion, then you'd need the whole issue to you know, make any difference to your performance. So, you know, it's not something that you know, they can play in, whereas myself and you know, a couple of others, you know, can.
And that's your kind of secret sauce. You have the ability to buy and hold things that perhaps the PIMCOs and the big bond funds can't do, kind of thing.
That's exactly it. Now, I also saw in the questions there, what is the advantage of being a Jersey domicile? Well, the obvious one to all investors is you don't pay stamp duty. But you know, can I pass that one to you for the technicalities why it's such an advantage of being in Jersey?
I mean, to be very honest, the advantages have diminished over the years. Jersey was a much better place 10 years ago because of their taxation rules. I think the UK market have recognised that and have equalised a lot of those rules. There are, as I say, the stamp duty is probably the main one for the fund at the moment. And the other big reason is to actually move it. If it's not costing us anything, it's actually very expensive. We'd have to do a full-blown kind of prospectus and get all that involved. And, you know, the fund operates, we try and keep our costs down. We don't really want to spend, and it's, you might be surprised to hear this, but it'll cost us maybe £1 million to move the fund from Jersey back to London again. And that's the cost that goes on to shareholders. So we don't really want to do that kind of thing at this stage.
No, I mean, I'm totally with you. I mean, I think it's important investors understand that.
Let's have a think. Duration, Franco, how long is the average waiting of duration in your portfolio? About 3 years?
It's still about 3 years, yes. I mean, we try and keep it, you know, somewhere around that mark, which, you know, most you know, high yield issuance comes between a 3 and 5 year duration in the first place. But you know, obviously, you know, if you've got AT1 paper in there, it's obviously perpetual, so it, you know, does push it out a bit. But you know, but by balancing the portfolio, we keep it down, you know, pretty close to 3 years.
And were you tempted over the last month or two to kind of sell and go into more cash? Did you get pretty worried about things, or?
Well, yes. Again, if you start, you know, selling your good quality income, you immediately hit your reason for being is, and your reason for being is to pay income. Now, if I'm selling stuff that is yielding 7 or 8% or 9, 10%, to take the sort of capital area down, guess what? We're going to have to use the reserves in quite a substantial way, which is not really a sensible thing in my opinion. As a shareholder, I would not want I'm being paid to manage the investments. I'm not being paid to manage cash.
Franco, someone just asked you what does tier 1 mean kind of a second ago. Tier 1 basically it's a capital requirement by the UK regulators and the FCA to say that financial institutions have to keep so much of their capital in a tier 1 bond, and that bond is basically available to kind of cover extremist situations. So it's not that highly rated sometimes because it's the first thing that gets paid out ahead of shareholders. Is that right? Anything else you want to say on that?
No, I think you've covered it extremely well.
But the important bit is that they're required to have it. So any deposit taking institution in the UK has to have tier 1 capital, and they have to issue a bond to do that. And a lot of investors 4 or 5 years ago, when banks were perhaps a bit more unsteady, shied away from those tier 1 investments. But you quite like them, Franco. You still think they're good value?
I like them because I have a very good analyst in Christian who understands the banks and the products and the way the capital structure works exceedingly well. And by and large, we are mostly in UK banks, which have a lot stronger balance sheets than certainly their American counterparts.
Okay, and Franco, I mean, your lovely silver locks are showing through today. Are you going to be here? Are you going to keep on managing for a while? You're not going to run away, are you?
Yeah,
shareholders are asking.
Well, absolutely. I mean, if I was run over by the proverbial London bus, there are people within the CQS team that can step in, as a team. At the moment, I fail to see what my brain would be able to do to keep it this active if I retire. My health is, for a 67-year-old, pretty damn good. I keep getting told by the doctor, so that's fine. And I love what I do. I enjoy making money for the investors. You keep thinking, right? Your markets are getting quieter. And to be honest, a quiet market, yes, it's a nice place to be when things aren't happening, but the brain doesn't have to work as hard. I mean, the brain is working exceedingly hard at the moment. I have recently reopened an X account because I want to find out what US policy is. So if I didn't enjoy it, I would certainly look to retire and hand over to the team that can step into my place. I said, we've got a lot of experienced fund managers and traders here. They do deal for open-ended funds, and obviously closed-ended is a different way of looking at things. But that's a relatively easy education as far as I can see.
Okay, thank you. Caroline, just a question for you here. The premium's about 7% today. Do you feel a bit uncomfortable with that? We shouldn't let it get that high. How do you manage that? How do you?
Yeah, it's a good question. I mean, you don't want it too high either, or you don't want to plumb the depths. I mean, the short answer is that when the premium starts to look a little bit frothy, we issue shares. And at the moment, when there seem to be plenty of opportunities in the market, and we have been issuing fairly steadily, $1 million here, $1 million there every week or so. and that hopefully keeps the lid on it. But it is a very good question, and we don't ignore the fact that the premium is where it is, and we're in a comfortable position because rates. If you dial back the clock a little bit, a lot of people were thinking rates would come down quite substantially more than in fact they have. And then perhaps there'd be less opportunities for us, because we are seeing opportunities when we can keep the income levels where we want them. So at the moment, we are quite comfortable continuing to issue.
Okay, thank you.
I mean, I'd add to that briefly that obviously, we try not to issue too close to the ex-dividend date, because unless the premium was really high, you do not wish to, if you like, do a quick swap from capital into income, for the new investors.
Yeah, I mean, it's very important. We should say that to investors that we're trying to keep a very stable share price for investors and shareholders. This fund could be bigger. We could go and issue a lot more shares at close to par, but we tend to try to keep the value for the existing shareholders and issue at a reasonable premium to kind of get the company and existing shareholders more benefit, basically, and not pay spreads. Franco, you don't like paying spreads. I'm going to quickly go through a couple of questions and try and answer them. Do we invest in secured loans? We have one in the portfolio at the moment. That's the fuel group from Morrison's, isn't it, Franco?
That is correct. Yeah, we've looked at the loans. Obviously, the Morrison's fitted the bill because it gave us a bit of diversification. Obviously, the prices are fairly easy to find on Bloomberg. So we can see where the liquidity is, but the actual time for transacting and settling is much longer than the 2 days we currently do on bonds.
Thank you, Franco. Shareholder worried about shareholder activism on this fund. Obviously, people may have seen that US companies, Sabab Capital being one, have been looking at the UK investment trust market with some interest, taking quite a lot of investment. Are we worried about that? I think I can quickly answer that by saying not really, because of where we are. We trade at a premium. I mean, there's nothing in it for anyone to attack us. If they would have to pay more than the company's worth to acquire control. So that's not very logical. The ones that have been under attack, well, their discount levels were maybe 10, 15, 20%. So there was an economic interest in perhaps buying those companies and trying to find some type of resolution closer to asset value. So we think we're not complacent. We look at our shareholder registers on a very regular basis, but we have no real institutional holdings in the company. It's mainly retail investors attracted to the yield, or through private wealth managers attracted to the yield. So no kind of activists or arbitrageurs in our register, I would say, today. Caroline and Franco, well, why do we keep a 1 year's revenue reserve? Why don't we just pay that out to our shareholders? Is a question.
Well, from my point of view, it allows the important element of continuity of the yield. You could pay it out quickly and everybody thinks, oh great, it's suddenly yielding 15-16% this year, and then they all sort of will cry into the sort of milk and sort of say, oh crikey, it's only yielding 8% the next year. Well, it's not a clever thing to do to remove your insurance policy, because we're seeing in current markets the danger of politicians. You can never guarantee what they're going to do, which can affect your income stream. And at the end of the day, I as a holder would much happier to see 8 to 9% coming in year in, year out, rather than let's do 15. Oh no, we can't do 8 next year, well, because we haven't hit the target. We can only do 6. Now that's not very, very good for the demographic of investors in this, which are my generation and older, by and large. Caroline, any more thoughts on that one?
Absolutely, I fully endorse that. I mean, ultimately, the dividends that are paid out are the board's decision, but we take advice from all those involved in running this company, and clearly CQS is a very important voice in that. I mean, what is the right amount of reserves to hold? I mean, it's an impossible question to answer, but somewhere which gives us a good solid base going forwards to keep the dividends steady and quite high, because we know that a lot of our shareholders rely on the income coming in from their holdings. So we want to keep that stable and increasing a little bit every year if we possibly can.
Yeah.
And
don't forget,
I don't see the reserves going wildly higher than where they are at the moment.
Yeah.
Perhaps never say never, but
I mean, I think if, and don't forget that 4p of revenue, 4.5p of revenue reserves is in the share price. So you pay that away, your share price goes down. So it's not all kind of gravy in that respect. It's already in the NAV. We're coming up in an hour. We may have to just quickly look a couple more questions, I think. Frank, you talked about bonds. What about equities? You've got a few equities in the portfolio. Do you want to mention any of those?
Yeah, I mean, I have. I mentioned Next Energy Solar. I have got a small amount of REITs in the portfolio. In some of the bigger equity positions will be M&G and Phoenix Group, which are exceedingly well managed businesses, and we're talking yield on M&G of currently 10.4, and Phoenix Group we have a yield of 9.5. So they give us a good steady bond like income, and when markets are more sensible, they'll probably give you capital. We also have a sensible size holding in Frontline Tanker Group, which is one of the leading, if you like, green tanker businesses throughout the world, which also has been giving us a yield of north of 10%. We did downsize the position when they were above $20, and we have or had bought back in more recently just around about $16, and they're currently at about 15. So they're down a bit from where we bought them, but I think when markets sort of are more sensible, and the sort of dark fleets of Russia and Iran, which are basically tankers over the age of 23, 24 years. If markets go back to using the better quality tankers, which they should do, these things will be back north of the $20 mark again, and the income streams from those can be substantial.
Here's a blast from the past. Bo Paran, the Chicken King. If we do a deal with the States and we buy all their chlorinated chicken, what happens to them, Franco? And do we still have it?
I think that personally, I wouldn't touch a chlorinated chicken, and I think, to be fair, yes, we have got Bo Paran in the portfolio, and to be fair, I think that if the government rolls over to let us have chlorinated chicken coming in, I think the consumers will actually go up against it, because you can get chicken over here in places like Lidl. You can pay about £5.40 or so for a 2 kilo chicken. Well, okay, if they're coming in below that, what have these things been fed? I'm sorry, I don't really fancy the idea of chlorinated chicken. You know, personally, I would much rather have a nice free range chicken, which you've got to pay a higher price for, but that's a personal choice. If you're not as wealthy and you've got a large family to feed, then to be honest, a chicken that gives you 2 kilos of meat for about a £5 sounds very good to me.
Okay, there's a few other questions there, but they're kind of on themes that we've already covered. I don't think there's anything particularly new there. Kind of closing question here is company size, 320, 330 million. Is that a perfect size? Could we go bigger? How would you manage that? Either of you, kind of?
Well, I'll crack at it first. Yes, it can go bigger. Do I want it at $1 billion? No, thank you, because you then end up having a problem again of sizing positions. Does it work at half of that at 500 million? Yes, it probably does. But again, only if you can maintain that premium, because there's 318 million pounds worth of investors that have all basically paid that 5 premium to get in. And if you were suddenly to double the size of the fund by issuing at 1.5% or 2%, you've just upset your entire shareholder base.
This might be a good comment to finish off our session with, but in my opinion, this company is a little gem, and we absolutely do not want to compromise that we've got a little gem by doing the things that Frank has just alluded to, doubling the size and creating difficulties with the investments that we've got.
Thank you, Caroline.
And thank you from me as well, Caroline.
Guys, if I may just jump back in at this point, and thank you very much indeed for being so generous of your time there and addressing those questions that came in from investors this afternoon. And of course, if there are any further questions that do come through, we'll make these available to you immediately after the presentation has ended. But Caroline, perhaps before really just looking to redirect those on the call now to provide you with their feedback, which I know is particularly important to yourself and the company, if I could please just ask you for a few closing comments to wrap up with, that'd be great.
Yes, thank you very much indeed. So I'd like to thank Franco for spending the time to share his investment thoughts with us all. And of course, thank everybody on the call, particularly if you're a shareholder. If you're not, perhaps you'd like to consider it now. And we intend to keep doing these webinars every so often. So please look out for those. And we look forward to seeing you again on the next webinar.
Perfect, Caroline, that's great. And thank you once again for updating investors this afternoon. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can really better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of CQS New City High Yield Fund Limited, we would like to thank you for attending today's presentation. That now concludes today's session, so good afternoon to you all.